Hey everyone, looking forward to this video as we explore the differences between a 401k with matching versus the build to rent model. Wasn't totally for certain what the outcome would be, but I think as you watch the video and see the end, you'll be very surprised at what the differences are on the return. There are good to both products. The 401k, there are trade-offs in either one. For 401k, it's set it and forget it. With the real estate and the build to rent model, it's definitely more active participation to some degree, but with that participation, there are higher returns and higher reward. And I thought I'd create this video because I've seen this discussion over and over again, and I wanted to look at it over a 10-year period. And what I always sell with the real estate and the investment side, it's not a get-rich-quick plan because this takes 10 years. This is a get wealthy for sure plan, but it's 10 years. It takes a little bit of effort, and there's different challenges with real estate. You're on the hook with the loan. So there's a little bit different variables to a 401k versus real estate. But I personally, later in my life, I wanted to get to financial freedom much quicker, and real estate was the path. And it's producing for me just in the first 5 years now. And I thought I would share these differences as we look at the different plans and see which might be better for you. I thought I'd create a video today on more financial talk. And I thought I would create some modeling of a 401k with 50% matching versus in that same year you purchasing a build to rent model like I have, and see which one over a period of 10 years produces the best return. So I thought I would create this scenario. I've seen this discussion out there on different YouTube channels and people bringing that point up of 401ks get the matching, and I wanted to try to create something as close to apples as I could and real world. I didn't know the final answer. I just had to work through the numbers to see what would the difference be over a 10-year period. The other thing I'd like to share is about investing in the stock market. In the past, I was a stockbroker about 25 years ago. And I wanted to share some things. Many people, if you're buying mutual funds or different returns in the stock market, they talk about average return. And I would say that's not the best evaluation of different products. You want to ask them what is the real returns over a period of time. Because what happens is it factors in the negative returns. So 1 year, for an example, so 1 year, if you were to lose 10% on your portfolio, the next year you wouldn't have to gain 10% to get back to break even. You would have to get to almost 14% return the next year to get back to zero. And what this is called the law of negative compounding. It has just as much magnified effect as it does on the growth side. It happens also in the reverse when you lose money 1 year. So like I said, you'd have to go from 10% loss. The next year you would have to get 14% gain just to get back to break even. So I took the S&P 500 over the last 30 years, and I asked and found out what's the average real return of your money. So I used that in my modeling for the investment side, and that comes out to 9.9%. I do the same thing with real estate. The average return over the decades has been a 4% appreciation and a 4% growth in rents. So what I did is I want to be extra cautious and create a more cautious scenario. So I discounted that 4% growth in appreciation and rents, and I changed it by 25% and made it only a growth over the next 10 years of 3% for both sides. So I want to get into that and answer the question, which produces the best return? So let me go through it here with you. Like I said, so here's the 30 years. S&P has averaged 9.9%. On your 401k, you're with a great employer, they're doing 50% matching. Right now, you can contribute up to $23,500 in your 401k in 1 year. And in this scenario I created, the employer matches it by 50%, so that's an extra $11,750. So in year one, if that happened at the beginning, and by the end of year one, let's just say you did it January 2nd, you averaged at 9.9%, year one, you would have $38,737. And also, you're using the way people get ahead is using good leverage, other people's money, and you are with your employer. You're using the $11,750. That's not your money. That is money your employer put in there. That's other people's money. So like I said, year one, $38,000. Over a 10-year period, averaging the real return at 9.9%, year 10, you would be at $90,601. So if you've only contributed $23,500, your return on your investment is 386%. That's good. That is a good return on your money. But we take the industry standard, and what they typically say is you want to only draw out, once you're in retirement, 4% a year, and you don't have to worry about in danger of running out of money at the end of your life. So with that example, you would have to save up, let's just use the example of $100,000. You would have to save up 25 times that $100,000 so that you could pull out $100,000 a year and not be worried about losing your money. So that is $2.5 million before you could retire so that you could pull out $100,000. The chances of that. So I looked at the statistics on that, and the typical person in a 401k, by the time they're 65, only 3% of the population has $1 million in their 401k plan by the time they retire. To 5 million, it's 0.01. So 2.5 million, you're probably in that less than 1% range of people that can attain that. And that is over a long period of time. So you see how hard that is to attain it. We call it the 40-40-40 plan, where you're having to work 40 hours a week, selling your life 1 hour at a time for 40 years to probably only end up receiving 40% of replacement of your income. So that's what the 401k plan is. 401k is not bad. It can be something you do in addition. But I looked at it in my mid 40s and said, can I catch up? Because I was busy with kids and growing a business and just living life. It was hard to get in there. Some of you, I hope you are, if you started this in your 20s, that's where the chances of you really attaining couple of million dollars in your 401k is starting as early as possible. So now I'm going to take that same amount of money, put that into one of my build to rent models, and see what happens in 10 years. So like I said, average appreciation over the last several decades has been 4%, both for rents and appreciation. I'm going to discount that a little bit and only put in 3%. This is my build to rent investment. I'm able to build this property at $205,000. It actually appraised just recently for $260,000. This just happened. So I'm going to put that same $23,500 down on the note. Now I have to pay closing costs, so I include that, the extra $7,000 for closing costs, for a total of $30,500. So that would be a loan starting out at $188,500, and I put an interest rate on that at 7.5%. And over 10 years, the note is being paid down. But the beauty of that, this is good debt. Good debt is debt in an investment that someone else pays, and your tenant pays this debt. So they've paid down this mortgage down to $163,600, roughly 24.9 $4,000. That, once again, is other people's money. Using the loan from the bank is also other people's money. That is 16 times the amount that your employer gave you that the bank is giving you to increase your return on your investment, plus this extra $24,900. 3 years appreciation would equal, for that property, from $260,000 to $384,000 that it appreciated to over 10 years. So then you take what your loan balance versus what it's worth, you're ending up with $221,000 of wealth that's in that property, plus the cash flow. And we're going to get into that here in a minute. Plus the cash flow. So what is your return on your initial $30,000? $725% return on just the appreciation versus $386,000. Does not include your cash flow. And what I did in the modeling is I had taxes, insurance, and even saving up for repairs, maintenance, and capital expenditures. I start out, because it's brand new, I start out at 7%, and I'm allocating the rents from the tenant, and I take 7% of those rents, and every other year as it starts to age, I add an extra percent down the road to eventually getting to 15%. So I'm mitigating my risk. So when I have those expenses, and typically on new homes, any major repairs or any repairs is usually happening after year 8 and going forward. But you're not paying for that. You're letting the renter pay for that. It's not coming from your pocket because you're saving from the rents that the tenants pay. You're putting back that money from 7% as it grows over time to 15%. The cash flow over those 10 years with those things that I put in the model to make sure I took care of all the expenses that would be typical, the cash flow over 10 years would be $47,000. Your return on your investment on that part for your $30,000 is 155%. So on top of the 725%, you could add 155%. So now you're roughly 880% return on your initial investment year 1 from that same year 1. What the cash flow piece, I took the rents starting at $2,100, and with that 3% appreciation by year 10, the rents at that time would be $2,740. Starting out at $233 a month in excess cash flow, and by year 10, you're having cash flow of $582 a month. What I'm saying is that, to me, my model, I would be looking at whichever one would be the better return. This one doesn't factor in the management by the 401k company with their managers. So there would be a percentage, and they take a percentage, though it may be small, whether you gain money or lose money. And in some ways, you're not in control. It's Wall Street. I like to have control over my own destiny and wanted to get to financial freedom earlier. And I showed in this model, I could get to financial freedom in less than 10 years. I have grown my portfolio with just now 12 properties to a net worth of over $1.8 million in less than 5 years. And at this point, still early in the process, cash flow over $30,000 a year. And in the next 5 years, you could see that grow. I'm continuing to add doors. But I'm looking at this model as the much better return on my investment. 401k, if you had enough to do both, it might be wise to do both. I'm not saying this is bad. 386% is good. I'm just holding my money accountable in something that I can control. And because it is active participation, you're getting more return and more reward for your investment dollars. The good thing with the 401k is it's very passive. You're setting it and forgetting, and you don't have to be actively participating. With properties and investing in properties, there's a little more work involved, but I thought I would share that, seeing which one was better over a 10-year. And imagine if you were to do this just 4 times, you would have a net worth of well over $800,000, almost $900,000 on just 4 properties, and have that cash flow. And that cash flow comes out usually tax-free because of depreciation and all the expenses. So you're realizing that monthly cash flow in 10 years, and throughout the process, it is money that you're typically not paying taxes on, because primarily with all the expenses plus the depreciation. In the 401k, once you begin to draw out that money, you're paying income tax on that money. With real estate, the government has created all these incentives in the tax code that create the ability to take out most, if not all, the cash flow that it produces tax-free. So I wanted to share this. Hopefully this is a very enlightening thing. It was to me, because I didn't know the final answer. I had to model it out to make sure, and I was trying to be very realistic because I wanted to make sure I'm holding my money accountable. Hope you enjoyed. Please like and subscribe. I look forward to producing more of these and more videos on my build process and some of the recent builds that I've done in the past. I'm looking forward to sharing those here in the next couple of months as I create those videos this spring. Till next time, talk to you soon.